Joining us right now is Anastasia Amoroso, global investment strategist at JP Morgan Private Bank. Charles Campbell is also here, trading desk specialist at MKM Partners. Are sirens going off in your office this morning?
Look, they're not. We've been watching this for a long time. And yes, we know that typically an inverted yield curve does lead to a recession with a lag. I would say in medium terms, it's about 11 months that the stock market peaks after the curve inverts, and it returns about 15%. But I want to point out...
So there's still 15% to go.
Well, potentially. And I also want to point out to 1995, because there was an instance where the yield curve was on the cusp of inverting, but actually steepened out. And the reason why that was the case was because the Fed over-delivered on market expectations for easing. So whatever the expectation was, they cut quicker and they cut faster. And so this brings me back to the Fed today. This is what they have not done in July. And this is essentially what has to happen going forward. If we are to re-steepen the curve, the Fed has to get out of being behind the curve. So they have to cut more than the market expectations.
95 was an unbelievable year, right? Because there were 3 in a row of 30% plus gains in the averages, right? So you're saying that the Fed actually did it the way it should have been done back in 95. They reacted to what was happening and prevented something bad from happening, and maybe so they could do it again if they do the right thing?
If they do the right thing. I mean, the historical parallel is pretty uncanny, because you had a manufacturing slowdown, you had the unemployment rate that was at the lowest point in 20 years, and then you had the Fed cutting rates more than the markets expected. So the stock market did very well after that first cut in 1995. So this is why I think it is crucial for the Fed to focus on this yield curve, because I get the dual mandate of full employment and inflation, but it's all these different things that ultimately matter to full employment.
Charles, are we in 1995? Are we in 1990? What year are we in?
It's a different year that's not comparable to prior years, and here's why. The story here is that we've got a Fed that is behind the curve. Market-based indicators since the 5th Fed meeting, July 30, 31st, all indicate and are consistent with a Fed behind the curve. The 3-month 10-year, which is what the San Francisco Fed said last fall, is the best metric for predicting recessions, the least number of false positives, has been further negative, minus 30 yesterday, and it continues that way. Break-even spreads, tip spreads, all shallower, okay? Iron ore prices. China's the largest consumer of iron ore and copper. Iron ore in Asia down 20% just since that July 30 meeting, all indicating a slowdown, all indicating tightening. You combine that with the fact that the Fed has contributed to every single recession, except for one in the 1960s, in the last 60 years, and we can see that the market is telling us the Fed is behind the curve. They tightened 9 times, they loosened 1. We're now at risk. And that's what's going on. Now, the reason it's different from 95 and prior periods is you've also got a trade situation between the U.S. and China. Incremental GDP growth between the 2 largest countries in GDP is 47% of global GDP growth. China's 30, we're 17%. That's why this is so critical.
Let's say the Fed catches up to where you think it should be on the curve. Let's say the Fed lowers Fed funds rate to 0, and then we still enter a recession just maybe a few months later. What is monetary policy's role then?
That's a good question. So here's the situation. 20 years ago, we had one sovereign debt that was really in negative yielding, okay? That was Japan. Now, Japan is negative yielding out to 15-year terms. We've got countries all across Europe. 24% of sovereign debt worldwide is negative yielding. Why? Because monetary policy is doing all the work. Fiscal policy from elected officials is not carrying much of the ball. The stimulus is not there. Our measures of GDP and inflation, I would submit to you, are probably not accurate, because the models that policymakers and economists use have not kept up with technological developments.
What do you think the chances, though? Can I just go back to this idea that the market could still be 15% off of its highs before it goes into this recessionary move? Do you think that's possible?
15%, meaning we will decline 15%?
No. I think
we will rally 15%.
I think she's saying that there's still an opportunity to rally 15%.
Absolutely. Sure, we could go to 31.
Now, whether you want to try to trade that or not, it becomes a bigger question.
Well, I mean, yesterday's move up, melt up, 60 move higher in the E-mini S&Ps. Hedge fund guys have to participate in that. They can't sit by and do nothing. So most of them get involved with that. They may not believe it. They may not have high conviction, but they begrudgingly get involved.
I think still unfriendly towards the market.
Am I still unfriendly?
I don't know. You feel like you have a downward sort of a view of that maybe we might get 15, but
my job is to ask the question.
This is to answer your question. I think there's many excellent trading opportunities in the markets, right? Between now and 12 months from now, you may have a period of time in August where we do want to protect a little bit against further downdraft. But if I look out to September and October, I do actually think the Fed has a chance of catching up. If they do cut by 50 basis points, they may be actually successful at re-steepening out the yield curve, because that's what the long-term bonds really need to see. And then what if President Trump does continue to back off the recent escalation, which, by the way, there's some theories out there that maybe that is the case. Maybe that's the playbook.
There are a lot of flashpoints, though, in the next 6 months. I mean, maybe you call them trading opportunities, but you have, this September 1st tariff deadline. You have a phone call that's supposed to happen before then, in-person talks that may or may not happen after that, the October 1st holiday, the December 15th day. I mean, do you buy or sell going into those? Because anything can happen.
Right.
That's what we've learned.
So we've thought of the markets in 3 different stages. Past the big downdraft last Monday, we were saying that there's a relief rally likely in the making, but use that relief rally to add some protection, especially for August, because weak seasonals, weak liquidity, and then who knows what's going to happen on the escalation front. Then longer term, the third stage of this, I do think that there's a Trump put, there's a Fed put that will kick in maybe September or sometime before year end. So you do want to be positioning for that rebound. And by the way, for tactical investors, the options markets have given us excellent opportunities to do that.
And with a market that goes up over time,
right?
The question might not be, do I trade this for the next 15%? But do I worry about the inevitable pullbacks that we're going to have from 15% higher, or do I just stay long and
that's
it goes from 800 to 30,000?
And I would give you one sector to stay long.
Worry about trading the next 15. Worry about just invest in U.S. companies and U.S. growth, Andrew. And
if I told you that
you're a young man,
if I told you there was going to be a recession in the next 18 months,
okay,
you might want to sit tight a little bit.
You could buy cheaper.
You might be able to buy cheaper.
How good do you think we usually are at selling and then buying?
But that's what this whole conversation is about every single morning.
Well, one thing, if you're not willing to take tactically and you want to buy something for the long term, I would say look at buying healthcare and look at buying European healthcare specifically, because healthcare tended to be the sector that outperformed past the third Fed cut. And by the way, European healthcare gives you a yield of 2.88%. In the environment where the G10 government bond yield is 0.6, I take 2.88% any day. And it's also a sector that is seeing its earnings inflect. So if you are going to buy one thing, Joe, I would suggest European healthcare.
No. Comcast.
Comcast?
Yeah, that would be my, don't you think?
That's the only thing we're allowed to buy.
That's right.
So that helps.
Hence the,
double down on margin.